Okay, we're in part 2 of our methodology. I thought I could do it in shorter time, but I had to go on to a part 2. We were talking about the valuation, and I'll quickly review. It's the fixed capital plus the working capital plus the returns above the cost of capital in the future. And then we say that's the total value of the company. We take out the debt. Whatever's left over is the value of the equity. Okay? So we want to say it's a value added model, right? So we're going to take the accountant's assessment of fixed capital at face value plus working capital at face value. That's pretty straightforward, to be honest. Working capital is nearly cash, so that should be worth what it's worth. Fixed capital is really pretty close too. Remember, this is the depreciated amount this time because it's valuation and it matters if you've got older assets. We do inflation adjust that though, because again, you know, if it's recorded at historical dollars, but the cash flows in today's dollars, you want to put those on apples to apples basis. Okay, and then value of debt minus value of equity. So if we know all these pieces, if you think about it, this is right off the balance sheet with a bit of an adjustment for inflation. This is off the balance sheet. This is off the balance sheet. We're trying to get this. All we have to do is get a pretty good estimate for the number 2, the spec piece, and you know we got a good valuation. Okay, so that gets us on to our next slide. Okay, here we go. I'll remind myself how to do this. That was not it. There it is. Okay. We're going to use the concept of competitive life cycle, right? So this is well-known economic theory. In a startup of a company, I mean, I shouldn't even call it theory, it's just a fact. A startup, you put in the capital up front, you're not getting a good rate of return to begin with, and eventually you can slow it down a bit, but you're still growing, you're still putting in more capital, and if things go well, you're going to earn a high rate of return. And then you don't have to, again, you don't maybe invest quite at the same rate. You're still growing, but you're on a bigger base too. So still growing, but what happens typically if it's a good business, competition comes in. That's that red behind in the background there, and it's going that's a competitor coming in and taking down returns because they're going to come in, cut prices, and maybe be more efficient. Do something a little differently, and you're going to be forced to do something better and different yourself, and it's usually less profitable. So in the long run, companies earn their cost of capital. Okay, and the degree to which you fade, that's also what this red would represent, is two similar companies, one didn't fade as much as the other. The one that didn't fade is worth more, and or we suspect isn't going to fade, because this is all about the future. We're just predicting the future, and we can't predict it with certainty, but we can at least use some principles, right? Because we know in economics this is a phenomenon that happens. It's not even it's not a wild prediction. This is seen over and over and over and over in every industry. Okay, and I don't think it'll ever change. Now, the degree to which you can build a competitive moat, that's not a wide moat, that's what I want. You can ward off the fade. Okay, so that's certainly something you want to try and do. And there are a lot of companies that have natural monopolies, and until somebody comes in, like government regulations, you've got some good monopoly rents. Okay, so that's okay. That is pretty much the 4 slides. Okay, I do usually with my institutional guys jump into some of the software and some examples, which I'm going to do here as well. I can't be as thorough, but I can do a few for sure. And let's jump right in. Okay, so we have Home Depot. Check out Home Depot's return on invested capital. It's been a pretty good run of return on capital. Well, let's say this is 2000, the very first bar. up to about 2008. Anyone who was around investing in 2008 would remember the housing crash very well. Okay, and you don't even really see it here because the returns are so high that returns in the stock that this is a distorted downturn. You cannot see how bad it was. It was quite a downturn, and that's just a scale thing from the. If we took away this big, huge rise over here, this would look like a bigger downturn, but it was correlated with the return on invested capital. Okay, you can say which one came first. It's hard to argue, but it's definitely correlated. And when you see that return on capital going the wrong way, believe me, you need to get out of the way. But then, the economy and everything else fixed itself, and Home Depot just roared back. I mean, it just completely roared back. It was unbelievable. It's been a great run for this company. And now we're saying, okay, remember our competitive life cycle. Let's see if I can go back to that other slideshow. Here. There, that's the competitive life cycle. So I would say Home Depot's, I don't know, somewhere around, maybe right at the peak. Maybe, we don't know for sure, but it kind of looks like the peak. Let's go back to computer. Oh, wrong one. There we go. And yeah, so remember, this is actual, the light blue, and then we model a natural fade, but that doesn't mean they couldn't, they could keep going up. So it maybe looks more like a peak than it actually is. We're not sure, but we're going to model it that way. So as we model it that way, we get $163 value. It's trading at 186. But what you would want to do with a company like this is start thinking about the fade. Like, what if it doesn't, go on this steep slope in the long run? Let's try, a lesser of a slope. And whoops, what happened there? No, let me reset the default. Something went a little off the rails there. So we do have that button to just get us back on track. And there we go. Okay, now we're going to say it's not going to fade at the same rate. Let's use that 6%. And you see that it's hard to maybe see on the video, but this slope is not as steep. In other words, it's doing better than our default fade. And then we'll say in the long run, instead of earning an 8%, let's say it earns 10, which it's clearly done better. I mean, its worst, even in its worst of times, was 9. So I think 10 is very fair. And it's actually worth $228. So cool. That's awesome. So there's Home Depot. Let's go through a couple more examples. Tech Resources. Okay, very cyclical stock, right? What I really want to point out here is the return on invested capital, and the stock is very correlated. So in this time frame, returns were going sky high, putting in capital, and the stock was going crazy, and then it just crashed out. The returns came right down, and so did the stock. And right near the bottom of the return is right at the bottom of the stock. Things improved. It's a little bit. I mean, there's some distortion. It's not perfect, but returns were starting to improve. The stock improved, and then essentially was not sustainable, and came all the way down again as returns came down. And not coincidentally, the return on invested capital and the stock bottomed out at the same time in 2015. And now returns are improving, although they improved for a couple of years. Now, is it turning over again? And is it noise? Is it real? Is it, these are the things you got to figure out. Like, there's no easy answer. I wish I could just tell you. I can't. But I can tell you, I know it's been improving. I don't know if this is it's a little head fake on a downturn, or that's real. I mean, this is where you got to really debate with yourself and figure it out. Okay, let's just skip through a few more examples and wrap it up. Okay, Procter Gamble. This is a company we say would normally beat the fade. So our default actually comes up with quite a substantial haircut, but they really have only, the worst they've ever done is 12% return. So our model is too punitive. I'm going to change that to be, maybe we should change our default, but I just do it as an analyst, and I'm going to say they can earn a 12 in the long run. And we get much closer, $88 versus 99. So, maybe it's a bit rich right now. We've stretched it, but it's not far from reality, like what we're trying to do there. Like, I think that's a realistic picture what they would earn. The market is pretty smart. Our model kind of matches reality. Okay, so a couple more examples. I think Google, that's a great one. Look at the consistency of Google over time. And it's even been, they put in a ton of capital too. So sometimes you put in all this capital and your returns come down, which is happening a little bit here. Not terribly, but a little bit. But you remember, this capital is just, they're throwing money at every project they can come up with. And the cash flow often still takes time to build up, right? Like, just like our slideshow, right? But they're doing this like project after project after project, and it's like many companies within one company, and we're just seeing the overall. But now we're seeing a little bit of an improvement in return on capital, and I love that. Like, believe me, I know improving return on invested capital, the stats are in. Even if the valuation's not the best, improving return is highly correlated. Not 100%, but highly correlated. Okay. Well, I am more long-winded than I thought. Bed Bath & Beyond. Let's take a look at one kind of going this wrong way. Great company for many years. It had a little bit of an issue in 2008, 2009, just like many companies. But bounced right back, and then unfortunately didn't last. Turned over, and it's pretty clear to me if you look at that return on invested capital and the stock price, which is why we overlay it, by the way. We have the overlaid chart here. It's the same chart as this blue one on the bottom. It's just, the blue one shifted relative to the return. So we lined up the time frames, we overlay it, and you can see the correlation with your own eyes. Okay, so now it does look cheap, so that's nice to know in my mind. I don't buy it just because it's cheap. I'm looking for that turn. If this thing started to turn up even a little bit, I'd be like, oh, okay, I got good valuation, and returns are going the right way again. I could get behind that. As of now, all we have is good valuation, and we don't have a turn in the actual fundamentals. Okay, one more example, and it's a difficult one. It's Square. So Square on our default looks like a complete disaster. It is not. It is simply that it is in the beginning stages, a startup phase that is not easily modeled on our default. I want to go back to the slide images. We've seen two. Yeah, that's where I want to go. And there it is. Okay, so it's right here. Yeah, it's a lousy rate of return. And unfortunately, our default doesn't go, it's going to earn like 20% down the road. Like, we just wouldn't do that on a default basis. We could do it as an analyst, and I'm going to right in front of your eyes. But this is happening. They're putting in a lot of capital. Returns are a little low for the time being, but we expect some sort of return like that. Okay, back to the thing. And what I like to do, see, there's the capital building up. There's the lousy returns. But they are slightly coming out, right? They were negative. Now they're only -4. So we're getting there. I like to reverse engineer this, okay? They're growing capital at an astounding pace of 70%. So I'll do 65, so be a little bit more conservative. And you'll notice the valuation doesn't even really change because they're still not earning the cost of capital. So they're just spinning their wheels in the scenario I built. But I'm going to go down the road and say, oh, they're going to earn 15. And I'm doing this in real time. I did not prepare this in advance. And I go, whoa, that's worth $291. It's only trading at 77. Okay, maybe I'm being too aggressive, but I don't know. Am I at that? I don't know. Let's take this growth rate down. Let's go 55 instead of 65. Okay, and 143. Okay, still too aggressive. Let's go 45. Okay, still earning that. Still got to earn that 15 at some point. So I actually want to go a little bit the other way. You can see there's many permutations and combinations. I could literally do this all day and get the right answer. But I want to try something. I want to go, okay, let's do 20. So I took down the capital growth, and then you're earning a 20% on lower capital, so it's obviously worth less than earning 20% on bigger capital. Okay, but so what I want to do now, and then say, okay, but now it's going to start to beat the fade. So maybe I was too aggressive on the fade, and I'm going to come up with a scenario here, and I'm roughly fairly valued to actually a little bit over. Actually, let's go back to fair value. I wanted to show a reversed engineered scenario where instead of saying what we think it's worth, we're telling you what the market's paying for. Market's paying for 35% growth in capital, and that they're going to earn a 20% return on invested capital. And that's worth $83. Or fair value. Let's call it fair value, because I wanted to get what the market is paying for now. Okay, got that. And is that possible? Well, of course it is. Google did it. Google's doing it now. So why can't Square? I mean, Square is widely touted as kind of one of these next up-and-comer Google type. So I'm gonna say, hey, it's actually not that aggressive. I could put more capital in. I could give it a bit better return, less of a fade, and I could easily get there. So I do support some companies that are kind of in that phase. They're harder to analyze. They're more difficult. We don't have any magic formula for it, but we can do it, and if something special comes along, we'll make those adjustments. Okay, wow, I cannot believe I did 2 17-minute presentations on our theory, but this is the company. This is what you're paying for. This is all of the knowledge behind it, our intellectual property, if you will. I hope you enjoyed that.